Hello, everyone, and welcome to our webinar, Redefining Your Risk Framework. Today, we are going to be looking at new forms of risk related to environmental, social, and corporate governance issues, and explore how companies can prepare for and adapt to increasing regulatory requirements and stakeholder pressures for more transparency on these issues. First, I'd like to introduce you to today's speakers, Steve Santini, Paula Luff, and Kevin Beauregard. Good morning.
Good morning.
Steve Santini has over 30 years of experience in the financial services industry, having worked previously with Salomon Brothers and Bank of America, where he developed trading and cybersecurity systems. Steve now advises companies in cybersecurity and strategic infrastructure strategy planning. Paula Luff is founder and CEO of Viso Strategies Corporation, the only founder, a sustainability advisory firm based here in New York City. Paula was most recently Vice President of Corporate Social Responsibility at Hess Corporation, where she established and led the global social responsibility and philanthropy functions for the company. Kevin Beauregard co-founded Get the Net in 2005. A compliance and operation risk consulting firm servicing the alternative investment and investing banking communities. From 1998 to 2005, Kevin was a founding member and managing director of Bank of America's Equity Financial Products Unit. Thank you all for contributing to today's discussion. We're delighted to have you here.
Thank you.
My name is Suzanne Cadis, and I work with eRevalue. We're a women-led tech firm with offices in London and New York City. We use big data analytics and natural language processing techniques to monitor emerging regulatory, reputational, and competitive risks for companies. Prior to eRevalue, I worked with the Global Reporting Initiative, the leading standard for non-financial reporting. This is where I had originally met eRevalue CEO and co-founder Mariella Alma and our chairwoman Hella Bank-Jorgensen. Just a few housekeeping rules before we sink in. Visualizations will accompany today's discussion. These should now be visible on your screen, but they are also available for download on the control panel. You can see that handout. We will start today's discussion by looking at emerging regulatory requirements and then move into a discussion with our speakers. This will be followed by an interactive Q&A with you. We'd love to hear from you, so please feel free to pose any question by typing it into the chat box on the control panel. We'll use the final 15 minutes of today's discussion to address those questions. For sound quality purposes, we will keep all participants on mute throughout the webinar. A recorded version of the webinar will be made available and emailed to you afterwards. So with that, let's jump on in. Today, there are about 10 times the amount of non-financial disclosure requirements on environmental, social, and corporate governance issues than just 3 years ago. This image that you see on the screen shows recent and emerging initiatives in the Americas. Globally, we see a shift from voluntary to mandatory disclosure requirements on complex issues like human rights, customer privacy, and workforce diversity and inclusion. These so-called non-financial issues are no longer optional nice-to-haves in business. They present real financial, legal, and reputational risks that impact companies operating in all industries and jurisdictions worldwide. Let's look at a couple of examples. If we look at human rights and supply chain due diligence, for instance, we see over 30 new initiatives emerging just last year. These initiatives, like the Modern Slavery Act in the UK, place increased accountability on parent companies for actions in their supply chains and subsidiaries, as you can see in these examples on the screen. A key question is, are companies prepared to publicly address these issues? We've already seen companies like Costco face class action lawsuits due to allegations of forced labor in their supply chain. Based on our analysis of public disclosure by the top global 500 companies, we see that about 41% do not address these issues in their 2015 corporate filings. These filings include SEC filings, annual financial reports, and annual sustainability reports. But it's not just the legal courtroom that's changing a company's risk landscape. These risks are emerging from multiple sources: competition, suppliers, clients, regulators, the media, and the public. They extend across the value chain and transcend departmental boundaries. The courtroom of public opinion is often a good predictor of the real courtroom. Signals in the media and voluntary reporting frameworks that can help companies anticipate regulatory change before it actually occurs. If we look at the recent Apple and FBI backdoor debate, we see how this event has put the issue of customer privacy and security in the spotlight of media, the public, and regulators. Regulations are emerging both in the US and Europe that could result in up to $10 million in fines. One regulation is a recent EU-US privacy shield referenced in this news story that you see on the screen. The privacy shield will impact over 4,500 companies operating here in the United States. And yet, we see limited disclosure on this issue by the top global 500 companies. As you can see, 38% of these companies do not mention the issue of customer privacy and security, as well as related issues, in their public disclosures from 2015. So with increased pressure, more information to sift through, and more opinions to heed, how can companies keep these risks under control? The past year is riddled with stories of success and failure to do so. We're witnessing the impact of the Panama Papers and continued unfolding of the VW emissions scandal. On the other side, we also see financial outperformance and greater returns by companies proactively addressing these issues. Each of these developments reinforce the inherent link between corporate transparency, effective governance, and competitive advantage or disadvantage. At the end of the day, on which side do you want to be? Or as Paula Luff said earlier, do you want a Pulitzer Prize article written about modern slavery in your supply chain? With that, let's hear from the experts about how you can prepare for these new forms of risk. Steve, let's start with the basics. What are some of the building blocks necessary for a robust risk management process that can help companies adapt to this fast-changing landscape?
Yeah. Thank you very much. This is a great question, especially because the threats are happening faster than the regulation can keep up with. Because of that, we're kind of left to our own devices to come up with a risk management construct. And to do that, we start with culture. But I believe that there are three cornerstones to an effective risk management process. The first is credible information. We have to have trusted information. It's the foundation to any risk management process. We must be confident that our decisions are based on accurate facts. So we have to get good, solid information into our company. The second part is an intuitive risk framework and a defined taxonomy that goes along with it. This is the architecture that sits on top of that foundation. An intuitive framework defines the problem that you're trying to address and the terms used in a way that resonates with people. And it's very important because people have to understand it to use it. So let me give you a simple example. This is a three-piece little framework. For risk, we have inherent risk, which is the risk that is present without any controls. We have mitigating controls, which are processes that we institute to reduce the risk. And then we have residual risk, which is the risk that remains after the mitigating controls are there. Very simple. Inherent risk, the mitigating controls, and the residual risk. We want people, as they're thinking about their issues, to think in these terms, and there's a very important reason why. That's because when you all use the same type of framework and the same taxonomy, the various divisions of a company can start adding the risks together and seeing how it goes up through the company. So it becomes very important to managing risk across a company that everybody have common taxonomy, common framework. The last piece is an effective governance. This is the structure of accountable decision-making and execution that really is the risk management process. So what we really need is a set of management routines where issues are brought to the attention of management, decisions are made on how to handle these issues, and they're documented because they may end up being evidence, and that we're tracking the execution to ensure that expectations are met with regard to that. So just to recap it, there's three basic building blocks. It's credible information, an intuitive risk framework, and governance, making sure that we're doing the job.
And Paula, that reminds me of a discussion we had earlier where we were talking about the different types of expertise required to really understand and get ahead of these emerging issues in companies today. Based on your experience, what type of expertise do you see needing to be at the table looking at these issues?
Yeah, well, I think when I first started in this space in the mid-90s, companies were looking for people who had deep knowledge of the NGO sector, civil society, and government to kind of bring that knowledge into the corporation. Over time, that's evolved. And I think the most important skill and knowledge base that a chief sustainability officer or someone working in this space in a company could have is profound knowledge of the business, of how the private sector works, and credibility with colleagues in operations. That's because CSR has evolved from being kind of a nice thing to do, as you said earlier, to being mandated. And companies that are really effective in this space have seized the opportunity to integrate this kind of risk management into how they operate. It's operational excellence now. It's not just about, nice things that you do for reputational benefits. So that I think is really, really critical, that deep knowledge of the business. I also think that in terms of skills, I always called myself the quintessential interpreter in each company that I've worked in. My job was to interpret that civil society, external stakeholder perspective for my colleagues and for management, but likewise to engage with stakeholders and interpret our reality as the enterprise for them and find common ground. While shareholders are terribly important to the enterprise, in 2016, it's not just enough to say, my job as an enterprise is to create shareholder value, full stop. Stakeholders have immense sway over a company's ability to be competitive and to be successful. Stakeholders, whether they're regulators or employees or customers or business partners, have tremendous ability to create and I would say erode value for the enterprise. And so one needs to engage all stakeholders, not just shareholders. One of the challenges also, I think, in being an effective interpreter is getting the right data. And I'm sure we'll talk about this with our colleagues on the webinar. There are competing data sets, right? We were all in lengthy conversations about metrics. What are the right metrics for this space? Are they material? Are they not? I know that, you at eRevalue have a great system for not just kind of looking at metrics in a meaningful way, attaching it to risk, but also, I think, horizon scanning, which is the last skill I'll mention before I stop my lengthy monologue here. Horizon scanning is really important. You can't just look in the rear view mirror or what's happening next quarter. You've got to be able to horizon scan, even though the headwinds in a corporation are to be very short term in view. Companies need to be scanning kind of what's over the horizon and how do we prepare for that risk.
That's a great point. And in terms of horizon scanning, what are some of the key sources of information that you need to take into consideration when you're looking at these issues from a risk perspective?
I think you have to stay on top of the regulatory trends, to your point. Regulation is made sort of looking in the rearview mirror. It's often in reaction to something that's happened, whether it's a big oil spill in the Gulf or human rights abuse somewhere. Governments tend to regulate in response to something. That said, there are certain elements in the regulatory regime that do look a little bit ahead. Right now, for example, the SEC has put up for comment a concept note looking at disclosure reform. And it's out for public comment now for the next 90 days. And a lot of the elements in that concept note are around the materiality of sustainability issues. So it's very possible, even though we always say, oh, this will never be part of the 10K, that it might. And now, that SASB is very much through its body of work. There is a tool, or there will be shortly a tool in place that will enable regulators to require companies to submit information that is standard and that is comparable across companies and industries in a way that we don't have right now.
And at the point about regulation being very reactive, Kevin, I'm wondering, can we see regulatory change as a way to improve business rather than simply as a cost to business?
The challenge is for people who are running companies today, as well as the boards, is accountability. Okay, compliance, regardless of what business you're in, being financial services, corporate, manufacturing, et cetera, compliance needs to start from the top. Procedures are put in place for firms, for employees to follow and to adhere to. Well, we have to constantly enforce that, and the accountability is there, both at the top and throughout the organization. So consistency is very, very important. Okay. Also, in today's world, more and more of the compensation structure that shareholders are putting upon, as well as regulatory for governments right now, is accountability about how I'm going to get compensated, both from a short-term and long-term perspective, with longer clawbacks. Okay, people want to be compensated for and be able to participate in the successes of the companies, and as such, okay, there's a responsibility associated with that. So there's that accountability, and consistency, as I said before, is very, very important. Okay, so in order to do that, you have to have the appropriate monitoring tools in place. How you go about monitoring, how you make sure that people are following through on their responsibilities, and how that information flows up. It has to flow down, but also has to flow back up again, as well as how far and deep do I need to go through my look-through from who I'm doing business with directly, as well as who my supply chain is as well. Where does that responsibility end? That's the very big question. You have anti-money laundering issues that are out there. With FinCEN has new rules that are becoming in place here in the U.S. Which we expect to take place sometime in the end of the second quarter, third quarter, and that's going to transcend through different parts of the industry. Okay, not just financial services, but also on a corporate world. Okay, there is also a huge branding challenge here as well. Okay, people don't want to see their company's names in a derogatory manner. That is so important. We need to make sure that it's a positive communication that's out there. So the heads of businesses want to make sure that they have a positive message to deliver to their shareholders and to the general public, as well as to the analysts that are looking at their respective companies. Okay, so that what ends up in my conversations with CEOs as well as board members, they're all afraid of the unknown. That's the surprise factor. When that happens, and in a regulatory manner, where essentially it has to be with regulatory sanctions, fines, and so on, those are the issues that they want to address and deal with. But they need to be proactive. As Paula said earlier, there are ways of being proactive. Okay, the regulators have been historically, reactive, and okay, we need to be proactive as running businesses, and that's where controls are put in place, both from the technology's perspective, they'll monitor, as well as procedures that were put in place, and accountability that's put forth to the respective employees. Okay, technology in today's world is our friend. It has to be. There's data upon data upon data. Okay, there's also risk factors associated with having that data available. Okay, you have regulators as well as shareholders want this information that's able to look at your respective business and how you're performing and how you're adhering to regulatory as well as internal controls. They want to see that in place. Okay, and there's ignorance is no longer acceptable. Okay, so I did not know. Okay, the issue comes back is the issue is you should have known, both from a officer's perspective as well as from a board member's perspective. The board now, more than ever, is being held accountable for the firms that they are sitting on top of. Okay, and that is very important, and we can utilize technology to help with that, deal with those issues. And the report, those tools, okay, are very, very important. Okay.
Yeah, that's a great point in terms of the importance of having information readily available and the benefits that technology can provide in terms of accessing that information and understanding that information. So one of the quotes that we appreciate at Erie Value comes from Stephen Hawking, and it's focused on the idea of talking, so of sharing information. I think one thing is very clear. We share a lot of information every day, and we're sharing information more rapidly through technology, as you note, Kevin, on social media, through our phone calls, our text messages, and all of this information holds informational value for strategic decision making. We are humans after all. We communicate through stories more so than we do through numbers. But we find that making sense of this unstructured data, as it's called, can pose challenges in terms of time, in terms of completeness, consistency, and accuracy, all great points that you had brought up earlier. So looking at technology today, how can we actually transform this type of qualitative information into something structured, something meaningful? One of the ways that you can do that is with the use of big data and natural language processing techniques. When you use these types of techniques, you can actually analyze narrative to quantify qualitative information. So you can look at the issues as they're being discussed by companies in their corporate filings, referenced in regulations, talked about on the media, from a very objective standpoint. And the benefit there is we can actually take these insights and generate actionable insights from them. So what you can see here on the screen is just an example of how you can do that by taking loose text or unstructured data, extracting the emphasis placed on that by companies within their corporate filings in this example, and then looking at how companies address a particular issue over time. We're looking at the Volkswagen example, which you may have seen already, and what we can see on the graph on the right-hand side is that there's actually a decline in disclosure by Volkswagen on the topic of air emissions in their sustainability reporting over time. If we look at unstructured data in different types of sources, if we look at the news, for instance, if we look at social media, the benefit there is that we can actually access this information in a very timely way. The power of technology is in the objectivity, scalability, and comparability of data that it provides, but it's also a question of timeliness and an ability to respond quickly to developments in the digital social media age. So just imagine not having to read a single news story, corporate report, or regulatory initiative to understand and anticipate these issue-specific trends. I see that we already have some questions popping up. So unless you'd like to comment on one of those points that we've just made, I can start going through the questions. Great. I'm getting nods from the speakers.
Sorry. The participants can't see us nodding.
So one of the questions that we have is a once a year materiality assessment. So looking at these issues from the perspective of what's important for my business, an indicator that the company is taking these issues seriously.
Personally, I think it has to be done more often than that. I think that it should be done, I mean, the exact frequency is to be determined by the company, but I think once a year, there's a lot that happens in a year. If you think about where we were a year ago versus now. I think it has to be more often, quarterly.
But it goes back to what I said earlier in regard to reporting policies, procedures, and the like. That reporting takes place during the course of the entire year, okay? And as such, the decisions are made people are put into place as far as control features and so on. So you need, it's an ongoing basis because compliance is embedded in your everyday life as far as managing a company. Okay, and you need to be looking at these types of issues continuously.
I mean, I would agree with you that it should be continuous, but it's almost like you're in the fog of war day to day. And as you're moving through that, I think you should discreetly pull out and say, okay, let's focus on this, look at it on a regular time interval. Because every day your practice should be good, but then you need to look at it in summary. I'm sorry, I might have cut you off there.
No, I think one way of, integrating this materiality assessment into more of the operating rhythm of an enterprise is to embed it a little bit more in the enterprise risk area and the compliance area, to your point, Steve, because they already have regular reviews. So integrating this stuff into the overall enterprise risk, overall compliance, operating rhythm of an organization, I think would make practical sense. And I think it is doable.
And Steve, earlier when we were talking about the webinar, you mentioned the word intuition.
Mm-hmm.
And the fact that senior management and businesses need to develop the intuition for these types of issues. So when it comes to developing the intuition for these issues, what have you seen to be an effective way to achieve that?
Well, I think the most effective way, well, then just let me clarify the point. So what's happening now is a lot of these threats that are coming, be it oil spills or cyber or whatever is hitting, it didn't exist 5 or 10 years ago. So senior management, who's been trained over the course of the last 30 years, hasn't seen these things, and they don't have an intuition for big, small, dangerous, not dangerous. And I think that what it really comes down to is they have to take the time to educate themselves to some degree of competency in the area. Kevin, I think you kind of touched on it a little bit earlier, but saying you don't know is not an adequate answer. Saying you delegated it is not an answer. And the successful executives that I've seen take the time to understand it and focus on it, not full time, but when they focus on it, they really focus on it. You can't just kick it off to the side. You have to pay attention to it. You can have your lieutenants that are doing it for you, but you have to pay attention to it because basically you have to report up. Depending upon where you are in the chain, you're going to have to report it up, even if it is to the board of directors, and say, we have control on that. And to your point earlier, these people are now personally responsible.
Absolutely. You have to be proactive in the escalation process. Okay, through the discovery process, people are doing reviews and doing the monitoring that they do as far as their controls are concerned. When they discover an issue, they have to be able to move quickly within the organization and address it immediately, because the longer time we take for it to be addressed, because the potential risk is there, it doesn't go away. It can actually get worse. I mean, we need to be able to move that through, and as such, you need to have a procedure to allow that to occur. Okay, because sometimes people suppress that information because they're of fear factor. You have to eliminate that. That is part of. We need to have that process in place.
And so just for the audience, that is what I was referring to by the governance process, because that is the accountability for decision making and execution against those decisions. And that includes passing it up and passing it down through the hierarchy to make sure that everybody is informed and everybody knows what has to get done.
And that actually relates to a question that just popped up. The question is, how do these structured qualitative insights drive investment decision making? So why is this information important for investors? How can qualitative information, looking at narrative, looking at tone of management, impact investment decision making versus only looking at numbers?
For me, I think there's a lot, and a lot of our colleagues on the webinar would probably agree. There's a lot in the literature right now, and sort of in the Twitterverse, about how good ESG performance, good environment, social, and governance performance leads to outperforming your sector. Right? Your company is going to be more profitable because you do this. I would argue that the causality is not so clear to me, but good risk management, good governance, good, managing any impact, whether it's legal risk, compliance risk, human capital risk, social risk, pick your risk. That's the hallmark of good management. And a well-managed company is going to perform well in the marketplace. And so that's why this is important, because this is part of good management in the 21st century. We live in a very complicated world where, everyone has a smartphone, not everyone, but a lot of people have smartphones, and you have a universe of information at your fingertips. The more ahead of the game you can be as a company, the more you can anticipate risk and opportunity, the better you'll perform, because you'll turn risk into opportunity and competitive advantage if you're a first mover.
And that actually relates to another question that's popped up. So someone said there's an inherent assumption that corporate performance correlates well with performance of society and the planet. The idea of a framework is important, but the data should be effective for people, society, the environment, planet, place. So essentially, the data needs to be considered within the context of the company, the industries they operate in, the geographies they operate in, the communities they operate in. So how can a company really understand what's happening at the local level while maintaining a global view, the horizon scanning point that you had made earlier, Paula?
Let me think about that. I mean, I think it goes back to stakeholder engagement, right? It's understanding your enterprise stakeholders, which might be the more global view, right? Engaging with them. First of all, mapping, understanding who they are, who influences your business on the global scale, but also who influences on the local scale, right? If your primary market is California, then you better know the lay of the land from the stakeholder environment. And you better have a plan that isn't just tick the box, oh, I called the regulator of XYZ agency once this year, so I'm good, I've engaged that person. But really understanding that stakeholder engagement is important intelligence gathering for the enterprise and an important communications vehicle. And so for me, it's really understanding the stakeholders and, and doing some triage, figuring out who's enterprise facing, who's regional facing, who's local facing, and having plans in place and people accountable for engaging with the various stakeholders,
right.
And reporting back to the organization.
And I would just tease apart the word stakeholder just so that we don't, so that we really
getting jargony.
Yeah, no, just stakeholder means a lot of different things to different people, but I think the interesting aspect of that question is the local level.
Right.
And there are local stakeholders. If you have a large corporate conglomerate that's selling cars and candy bars across the world, you're going to get different types of people out there. So watching what's happening in local news, local Twitterverse or whatever have you, but paying attention to the areas that you're selling into, I think is very important. So setting up the information flow into your company, very expensive to go out and do research on that, very easy to have the information come to you in this electronic day. I mean, we have RSS feeds coming from newspapers, et cetera. So channeling the information into you, I think, is really important.
To me, for the enterprise, just to build on that, a stakeholder is a person or entity, organization that has the ability to influence your operating environment or your business, either for positive or negative. So that's how I'm defining a stakeholder.
Yeah. Also, as I said before, you have to have a look through all the way through to the end user. Okay, if you're a consumer, how that your products, wherever you're manufacturing or whatever your business model is, how it flows through to the consumer, how it flows through, in both on a regional basis, on a more global basis. You need to understand how they're impacted, how you go about doing business, who are the third parties that you're touching as well, how are they affecting your consumer, and the like. So then there's that look through that I talked about before that becomes very important. You need to understand how that occurs within your business.
Mm-hmm. And I think that's a good point, actually, for us to go to you, the audience, and actually ask you a question. So we've set up a poll. I'll launch the poll, so you'll just see my screen move for a little bit there. And the poll is asking you to respond to which issues do you think present the greatest risk to companies today. And while you're responding to that poll, I can see the results popping up as you go. One of the questions that's popped up as well is, how can we look at risk from the perspective of opportunity? I think there's always two sides of the coin there. Risk can be seen as threats, but it can also be seen as an opportunity if we can get ahead of that risk sooner based on the points we've made around having strong governance practices, being able to access information rapidly, timely, in a consistent way. So we see some of the results popping up. I think you can actually see my screen, so you can see the results yourself. It looks like cybersecurity and customer privacy is on the top there.
And governance.
And governance and internal controls, yep. Okay, I'm being told that you can't actually see the results. So what we see now is about 58% of everyone who's responded sees cybersecurity and customer privacy as the key risk for companies today. We also see governance and internal controls. And it looks like third-party and supply chain risk is coming up, but climate change and environmental risk seems to be the third top biggest issue, and diversity and inclusion at the board and staff levels is one of the lesser risks, according to everyone today. So, Steve, I think this actually is a good point to go back to a conversation we had as well, where you were talking about how cybersecurity risk is now front and center for all companies, for all individuals. But you also correlated cybersecurity risk to ESG-related risks. And one of the things that you said is these two risks apply to everybody, and that's why they're so dangerous.
Yeah, and I'd like to say that you know, in this day and age, we have all sorts of new things happening. And, you know, 5 years ago, nobody knew what a DDoS attack was yet. Now everybody knows what it is, and cybersecurity is up in front. And historically, we might have had pieces of ESG risk that are out there that people were paying attention to, but nobody really understood it as a comprehensive practice. So I think that the important thing is that when you look at the various types of risks that are out there, some risks are going to apply to all companies. These types of risks, you know, you can think of them as enterprise-wide or corporate-wide, industry-wide. You're going to be cybersecurity, customer and privacy. I would put diversity and inclusion risk in there as well, climate changes as well. They're going to apply to anybody who's doing business. And there's going to be a second category of risk that's a little bit more granular that applies to some companies, but not all companies. So, for example, supply chain risk might apply to a certain type of company, but not to others. And then as you get even more granular than that, you start getting into individual risks that are associated with individuals as opposed to other subjects. So I think that many of the risks that are coming out now that are these industry-wide or you know, global risks, if you want to call it, I'm looking for a word that's big, global, we really haven't had much experience with, and that's why people don't have the intuition for it. These are new risks that are coming as a result of the commoditization of technology or the changing of the you know, the climate. Well, it's not like we had these 20 years ago, and so the senior management has to figure out how to deal with these and carry them forward. Does that get to your question?
Yes, it does. So there's a question that just popped up. Good to hear a lot of use of the word accountability, but to whom? So who is accountable for these issues? In discussions that I've had recently with companies, it seems there's not necessarily an understanding of who is accountable for these issues. So who at the table needs to take that under their wing, so to speak.
Accountability actually runs through an entire organization. And it goes back to what we talked about earlier, is that there has to be, there's a chain of command, definitely, but there's also, we put procedures and compliance, procedures in place, and to force our employees to abide by them. And there needs to be consistency. It's the most important part, and that everybody, is held to the same level of standard. Okay, we will not. I had a manager that once told me that the philosophy that he had when he hired employees is that he will not tolerate anybody putting, the families that he hires at risk. Well, that's the same thing here. We as business owners and CEOs of companies and the like, we have to hold everybody accountable, and then on board level as well, forcing the officers to be held accountable. Okay, so it's actually, and it goes through that entire framework of consistency. And if you are consistent, okay, and you hold out, people accountable, for their deliverables, for their adherence to policy, generation of revenue, cost, efficiencies, and so on, then you have a fighting chance. Okay, if you're inconsistent, that message is not easily disseminated across the organization. That's when problems occur.
I agree with you. I'd also like to add, what's interesting about this question is that the accountability has changed. So Kevin mentioned earlier that people on the board are now personally responsible. I mean, people on the board can go to jail now if they are negligent, right? That accountability didn't exist a while ago. And I'll give you a quick little cyber security example. It used to be if somebody was going to buy a cybersecurity tool, it would be some junior woodchuck in the basement that thought it was slick. And that's what made it get bought. Nowadays, if anybody's going to spend $1 million on a cyber something, you better believe that a very senior person in the company is going to want to know not what features it has. They're going to want to know what risk got reduced because we bought this in. And that's a new form of accountability that hasn't manifested itself yet. And to be honest with you, the little cyber companies don't know how to deal with it. They're not used to talking to senior executives. They're used to talking to, the nerds in the basement that deal with it. So the interesting part of the question is this accountability is changing, and it's definitely changing to be pushed up.
Also, the shareholders want their interests aligned with management. Okay, and as such, as I said before, compensation structures are starting to tie into that, where more equity is being distributed than that of cash, with a greater length as far as the clawback is concerned, because they want to make sure that people are being compensated the same way that their shareholders are being compensated based on the value of the stock. So therefore, decisions are made not for the short term, but for the long-term horizon. Okay, and that's really where things are moving towards, as well as the regulatory environment is changing. And there's also proposals, as I said before, that to extend that length of time period as well.
Yeah, and that brings up the point. I see a question popped up around this, around the fiduciary duty of investment managers themselves, taking these issues into account. We see that the definition of fiduciary duty is currently being debated. The United Nations PRI just came out with a new publication talking about how fiduciary duty is evolving. So I think it goes, as you said, on both sides of the table. The information communicated by companies needs to be understandable and digestible by the investors so they can make decisions based on factual, consistent information.
And I think, investors, again, are not a monolith, right? There are all kinds of investors. And I think when the large shareholders, the institutional shareholders, whether it's BlackRock, whether it's CalPERS, whether it's the New York State Pension Fund or the Norwegian Sovereign Wealth Fund, Norwegian Pension Fund, irrespective, those are the investors that I think really are driving some of this discussion. And I think we need to do a better job of engaging with them, because back to the accountability question, there's internal accountability in the enterprise that cascades from the board, but there's also external accountability to those kinds of shareholders, to stakeholders, to customers, and that's a little bit harder, right? So I think we need to engage some of the larger shareholders in this discussion, because I think the definition of fiduciary is changing. I think this whole webinar was about, we barely talked about financial risk, right? But traditionally, that's what we were supposed to all be managing, right? Financial risk. Sometimes a little political risk, depending on where you operate. But that's changed. And now it seems to me that the name of the game is financial plus a bunch of non-financial risks that impact your ability to be a good fiduciary.
Great. So on that note, I think we'll wrap up the discussion. Thank you all for your questions. What I'll do is just highlight some of the key takeaways that we discussed. So again, this will be shared with you after the webinar, along with the recording. So 3 key takeaways, or 3 cornerstones to effective risk management based on the discussion that we have. We see that credible information is key. It's critical for decision making. And we need this data to be timely, consistent, and reliable. And that's where technologies today can help. The second cornerstone is having an intuitive risk framework with a defined taxonomy. So understanding the problem landscape, understanding the solution, and ensuring that that resonates well with your different stakeholders, whether that be regulators, employees, shareholders. And the third point is about governance and corporate culture, which I think is really the overarching theme, is understanding where the accountability sits, having that start at the top, but also trickle down throughout the company, but also extending across the value chain. So with that, I want to thank our speakers and all of you for participating in today's discussion. We'll send through a recording of the webinar once we get that tidied up, along with the presentation slides. The slides have the contact details for each of the speakers, so please feel free to follow up and get in touch with either one of them with any pending questions that you may have. Here are the contact details for eRe Valley if you'd like to get in touch with us. Thanks so much for taking the time, and have a great rest of the day.
Thank you.
Thank you. Thank you.